Have you been trying to get your finances in order and start investing to create wealth but don't know what you're doing? Well, that's about to change. A new type of show, introducing the Dollar by Dollar Show. Welcome to the Dollar by Dollar Show, where we help everyday people become millionaires. Now, today we're talking about index funds. What's the difference between an ETF and an index fund? Now, quite often I see people have a look at their brokerage accounts. You've got all of these different types of apps with eToro and Superhero, all those ones, and they're looking at them and there's a hell of a different options. And some of them are called like the Vanguard S&P 500 Index Fund ETF. And they're going, well, what is an ETF and what is the difference between an index fund? Now, the main difference that I want you to think about is an index fund, in old terminology, is a mutual fund. An ETF is an exchange-traded fund which operates like a stock on the exchange. So you can buy and sell throughout the day, where a mutual fund you can only buy after close through a fund manager. So the flexibility for ETFs is enormous compared to a mutual fund, and that's why they're outpacing mutual funds. But if we have a look at it, we can go through and explain what an index fund is, and then what we can do is obviously highlight why an index fund ETF be for yourself, just due to its access, because you may not have an account with a fund manager. And also you can only buy mutual funds a lot of the time at a higher amount. So you can have a minimum investment is a lot lower with an ETF usually. So what I wanted to go through is the difference. And the answer to that is, when you want to invest in an index fund, what you're ultimately investing, like I said, is a mutual fund or an ETF, and it's based on a basket of stocks or index. The mutual fund or ETF is designed to mimic the index itself that it wants to track. So what they do is they create a fund that looks as much as possible like the index without actively managing the fund. The main idea of an index fund is that it's passively managed because the work's already done. You're just tracking the index as closely as possible. So an index is a collection of certain type and certain number of companies that make up the whole. The S&P 500, for example, the Dow Jones, for example, they've got different requirements that meet those ideas of what actually go into that fund. And what happens over time is the index changes. Companies get added, they get removed. So the fund that you've invested in will mechanically replicate those changes in the fund. So it's because of these approach, index funds are considered passive investments rather than active. Funds are considered passive investments rather than active investments. When we're talking active investments, that's when you have a fund manager. They analyze all the stocks. They try to pick out the best performers. Look, they've got higher risk, higher cost because it's actively managed. Look, a lot of the time they may have huge returns, potentially with lots and lots of subpar returns. So that's why we prefer the index funds, as they're performed much more consistently over time. So now the main differences as we went through. So an index fund is a mutual fund that aims to track the index, and let's just say the S&P 500. So when we're looking at it, you're along for the ride passively. When the index is up, your fund is up. When the index is down, your fund is down. With an index ETF, it happens exactly the same way. When the index is up, it's up. When it's down, it's down. The key differences are ETFs trade throughout the day on the exchange. Okay? Index funds, if it's through a mutual fund, trade once at market close. ETFs are cheaper than index funds, usually, because you don't have fund manager commissions. Index funds usually have higher minimum investment. Index funds usually have higher minimum investments than ETF. And the difference is ETFs operate like shares. So if the share is $112 and you want 2 shares, your investment's $212, where index funds are bought in dollar increments. So you go to your fund manager and say, I want this. So it's got some more flexibility for the index fund based on the actual dollar amount you want to invest in. But ETFs, obviously, you can buy a singular share a lot of the time. And ETFs usually are a lot more tax effective as well. So that's why, obviously, ETFs are a lot more beneficial. And another benefit of ETF And another benefit of ETFs is that they're a lot more liquid than index funds or a mutual fund, because ETFs are traded daily through stock and share exchanges. So there's a higher amount of transactional play there, which allows there to be a bit more liquidity. So in terms of that, that's always a... So really, what is the best option for yourself and what is the difference? So when we're talking about index funds and ETFs, they basically can be the same thing, because an index fund tracks the index. Look, EFTs are a lot more flexible. An EFT can track commodities, they can track specific industries, the indexes, a group of companies, whatever they may be. They can track a lot more varied range of things. But when we're looking at it, and if you go onto your brokerage and you can pull up the Vanguard S&P 500 Index Fund ETF, basically what that's saying is that Vanguard, it's tracking the S&P index, S&P 500 index, and it's traded as an ETF. So it operates like a share. So you'll have fluctuations daily and everything like that. That's basically what we're talking about in relation to an ETF and an index fund. So don't get ETF and an index fund. So don't get too worried and too confused about what the differences are, because there can potentially be no difference at all. So when you're looking at it, and if you're going through your online brokerage account, 99% of the time it's going to be an ETF because it's an exchange. So what you're looking for is obviously which fund. So I'll always have the fund name in there. And if you're looking for some of the top index funds that we recommend, again, we don't know your circumstance, but there's another layer as well, is because... So when you're looking to invest in an index fund, whether or not you invest in a mutual fund or an ETF, it does not matter. We've gone through the pros and the cons in terms of the ETFs are a little bit more flexible, a little more fluid and liquid. They give you access to online brokerage accounts that you can trade with them in, and they're traded like shares. And mutual funds, you've got a closing price, and it's traded through a fund manager, not as quite as liquid. At the end of the day, they're designed to do the same thing and be passive investments and following and tracking an index. So the number one on the list is actually a mutual fund. It's a Fidelity Zero Large Cap Index. So the reason that it doesn't have S&P 500 in this specific one, and it does actually track the S&P 500, is to get around licensing fees. So any fund with an index name in it usually has to pay a whole heap of licensing fees. So to use the S&P 500, for example, they would have had to pay an enormous amount of licensing fees to the S&P. In relation to this one, this is a 0% expense ratio. So the fund, it doesn't officially track the S&P 500. It tracks the Fidelity US Large Cap Index, which is the same thing. It's just an academic difference. So to do that, that's how they reduced, and they don't have to cop up for the licensing fees. So Fidelity Zero Large Cap Index, FNILX, is the number one index fund that we recommend. The second one is one I've already mentioned numerous times, been around for a long time, Vanguard. Highly reputable, very solid investment. Vanguard S&P 500 ETF. That's a really solid second. So that's been going for over a decade now, and trading on average returns. That expense ratio is 0.03. And how they do expense ratios is whatever the expense ratio is, it means obviously like 0.03% means that for every 10,000 invested, it would cost you $3 annually. So the expense ratios are quite small or low on these ones, because remember, they're not doing any of the work. They're just tracking an index. Not that they're not doing any work. They need to make manual changes when companies come in and company goes out, but they're not actively managed funds. The next one is SPDR S&P 500 ETF. So that's SPY. It was founded, 1993, so they've been around for a little while, and they're pretty popular. Hundreds of billions of dollars in the fund, and it's up there as part of the top popular ETFs. It's sponsored by the State Street Global Advisors, which is a massive, massive fund. Their expense ratio is a little bit higher at 0.09%, which means that for every 10,000 you have in there, it costs you $9. And the last one I'll throw in there is iShare Core S&P 500 ETF. It's over 20 years old, this fund, so they've got a good track record of over 2 decades of good returns and low expense ratio of 0.03%, so $3 for every $10,000 invested. And it's another large fund, and it tracks the S&P 500. These ones are specifically geared towards the S&P 500. Obviously, why? Because it's the largest fund on Wall Street, or the largest index on Wall Street. And that's what we wanted to obviously invest in for the most diversity based on the index fund itself. So lastly, I just want to go over, because a lot of people go, why can't I just buy a share? You can. Look, do you know how to value shares correctly? Do you know how all the ratios are actually determined? But differently, obviously, if you're not investing a large amount of money and diversifying through different industries, different companies and different sectors, and then hedging with commodities, all those sorts in different sectors, and then hedging with commodities, all those sorts of things, you're probably setting yourself up for failure, because it can become quite stressful, and the only time you lose money in the market is when you get scared and you sell. Because history shows us that if you hold on to your investments for a long time or a longer period, you inevitably make money. Think of it like a pizza. I order a pizza and it's just a cheese pizza. What do I get? Just cheese. Okay, if I order another pizza and it's cut into 500 pieces and there's 500 different toppings, I get a lot of variety. So that's basically the difference between investing in a cheese pizza included in that one. So if that one share went down, then obviously I lose money. However, in an index fund, you might have 20 different ones go down and 40 different shares or 40 different companies go up. So overall, it's a lot more diversified, it's a lot more risk averse, and it's a lot more stable. And history shows that it's made money well above 10% year on year. Okay, now when you're actually looking at investing in an index fund, another question that I had, once you've determined the difference and you've gone, okay, yes, I want to have a look at investing in an ETF. If you're on your brokerage account, you can see a whole lot. If you're on your brokerage account, you can see a whole lot of information. And so look, someone said, well, what's this and what's that? A lot of it's pretty simple. A lot of it you don't even have to worry about. Look, as long as you're investing in something with a low expense ratio, and you're investing in the right type of index fund to diversify, they're set and forgets. You don't need. Now, I've just opened it up, and let's just say the Vanguard US Total Market Shares Index ETF. Okay, so basically on there you've got what we call these. You've got open, volume, high, low, average, VWAP, previous closed market cap, 52-week range, PE ratio, and dividend yield. So basically, I'll go through those, and this won't take very long. And if you're looking at it, just to clarify it for you as well. So basically, your open is what it opens at the bell call. So in this one, it opened at 268 and 51 cents. Okay, so volume is for whatever period you're looking at, daily, weekly, monthly, yearly, 10-yearly. What you're looking at, daily, weekly, monthly, yearly, 10-yearly, whatever it may be. Volume is the number of trade transactions. The higher the volume, the higher the liquidity of that asset. So if you're looking at an asset and you've got high volume, it means that it's actively being traded quite a lot, which is a good sign. Open, we've got the volume, and then we've got high and low, as its name suggests, is the low of the day. You're always going to have a peak and a trough throughout the day. And basically, you've got the previous close as well. So that's the day's close that it was the day before. If you're looking at the VWAP, okay, this is where, well, what is a VWAP? It's basically volume-weighted average. What is a VWAP? It's basically volume-weighted average price. So if you're looking at it, it's the, depending on what period, it's the average traded price of that stock over a period that you've selected. So days, 6 months, whatever it may be, it's the average that it's actually traded at. That's really good to show you the growth over the last period of time, the last 1 year at a certain amount, and then today it's a higher amount. You obviously know it's tracking the right way as well. Market cap is basically the dollar amount or the dollar value of all the company's outstanding shares. So if it's this one here is $2.2 billion, So obviously at $268, you divide that 2.2 odd billion by the 268, and that gives you the number of shares outstanding. And then you've got your 52-week range. Look, that's just your high and low throughout that 52 weeks. Your dividend yield is just the dividend that they pay. Index funds usually pay a dividend, not huge. You do have some high dividend yield companies, but if you're reinvested, on average, they'll perform over 10% on average as well. If you reinvest that dividend, you get another 2% or whatever it may be. So that's where your index funds can get you 12 to 14% year-on-year return. And lastly, the PE ratio. Basically, the PE ratio is the amount investors are willing to pay for a share in a company relative to its earning. Okay, so look, if I was to put it another way, it shows how many years it would take for the company's earnings to match the current price of its shares. And how they work that out is basically its current share price by its earnings per share. Usually a higher PE ratio. At first glance, a high PE ratio suggests that investors believe it has high growth potential, whereas a low PE ratio would indicate that growth is expected to be slow or non-existent. But it's different from sector to sector. So usually the more conservative approaches will have a lower PE ratio. And again, the higher the PE ratio, a lot of the time it can be quite speculative as well. But look, with an index fund, you shouldn't have to go into all of this as well, because an index fund isn't about high management. It's about taking a standpoint on, look, knowing for a fact over the last 100 years, and indexes, S&P 500s and all those, Dow Jones, have performed above 10%. They have outperformed 99.9% of mutual funds that are actively managed, because you get fund managers that want to go hard on a particular stock and they lose a lot of money in a year. Sometimes they make a lot of money. And we're looking for something where it's low maintenance, it's low expense, and good high rewards for the risk that you're taking. Look, I genuinely hope that you found that information between an index fund and an ETF. Look, just to recap it for you, an index fund tracks a market. An index fund can either be a mutual fund or an ETF. You'll know which one's which because it'll have it in the name. Just like if it says Vanguard S&P 500, S&P 500 ETF. Vanguard is the fund. S&P 500 is the index it's tracking, and ETF is how it gets traded through the exchange. A mutual fund can only be bought through a fund manager after close, where an ETF, like I mentioned, trades just like a stock, which gives them great liquidity and flexibility. All right, guys, so thanks for listening to us today. If you haven't already, please give us a subscribe, and looking forward to fielding any questions that you guys have got, and have a great day.